Hi everyone, Nick here. Welcome back to my channel. There are a lot of possible risks facing our economy. We've had high inflation, high unemployment, unprecedented money printing, a spike in Delta cases, and more. Many investors are concerned about a possible market crash and how they can best prepare. Market crashes are inevitable, and it's good to prepare. But I think many investors miss the most important factors. In this video, I'm going to share 4 steps to prepare for market crashes. The first step is to acknowledge your abilities. Everyone wants to sell just before the market crashes and buy back in at a huge discount. This is market timing. The thing with market timing is your odds of succeeding are incredibly low. 90% of professional investment managers fail to outperform a simple buy and hold index strategy over 10 years. Do you know something they don't? Most investors do not. One study from Dalbar showed that from 1998 to 2017, the average investor got a 2.8% annualized return. The average investor suffered from poor investment decisions and likely poor market timing. An annual return of 2.8% is terrible. It is so bad, it's almost nothing after accounting for inflation. A simple buy and hold strategy with almost any of these major asset classes was significantly better. There are many studies that show why time in the market beats timing the market. For instance, this Fidelity study shows missing the best 5 days of a 40-year period resulted in a 38% lower investment return. Missing the best 50 days over that 40-year period lowered returns by 93%. That's 50 days out of roughly 10,000 days the market was open, or 1 day out of every 200 days on average. If you screw up and miss some of the best days, you risk losing a lot of money. Another study from Schwab compared different investment strategies. Over 20 years, someone that was perfect at timing the best day each year to buy stocks barely outperformed simple strategies like investing immediately or dollar cost averaging. The reward for the investor that perfectly timed when to buy wasn't really that much better than these simple strategies. The study from Schwab also covers 1,129 one-year periods, looking at every one-year period from 1926 to 2020, rolling monthly. In 75.6% of these one-year periods, the market rose. The odds for market timing are not in your favor. Your odds of succeeding are likely worse than gambling at a casino. So why do people make this gamble? It's probably due to emotions and fear of losing money. In my opinion, it is a complete waste to spend any of your time or energy worrying about the next market crash. Most of us cannot predict when it will occur. Even if we consume all the latest news about the latest Fed tapering, unemployment rates, and so on. Many investors never move past this step. It can be difficult to acknowledge something is outside your control, but we need to focus on what is in our control. What is in our control is supporting free financial education by smashing the like button. You can also subscribe so you don't miss my future videos. The second step is to consider why you invest and your investment horizon. I invest because I believe in the prosperity of the global economy. Look at the amount of innovation and improvements in the quality of life over the past 100 years. I believe this will continue. I believe people will continue to innovate and produce a higher quality of life. I'm investing for the long term. Does it really matter if there is a market crash in the next couple months or couple years? Over the long term, I expect it to be meaningless. This brings us to the third step. Different investors have different investment horizons, tolerances for risk, their goals are different, and their goals change over time. Your investment plan needs to match your goals. If a market crash next month is really going to impact your quality of life, you probably shouldn't have as much of your money at risk in the stock market. You need to carefully consider your risk tolerance and your investment goals. You should create an investment plan and asset allocation that matches your unique situation. Maybe you should have more cash reserves. Maybe you should have a higher allocation to bonds, gold, or other less volatile asset classes. Maybe you should diversify globally so your entire portfolio isn't exposed to the risks of a single country. Once you have a plan that matches your goals, you need to follow the plan. Far too many people change their plans based on some short-term trend or emotion. Creating a plan that fits your goals and sticking to it is the most important factor to being a successful investor. This is what my channel is all about. My goal is to help you become a successful investor and make better decisions when designing your investment plan. I've made videos about risk tolerance and asset allocation. These are the fundamentals of being a successful investor. The fourth and final step is increasing your value. You want to be someone whose skills are in demand. This has been the most powerful factor in my life. I graduated from university in December 2008 during the financial crisis. It was difficult for me to find a job, and the job I did find didn't pay very well. Instead of focusing on how to try to time the market, I focused on making myself more valuable. Since then, I've managed to roughly 10x my income. Think about how that would change your life. It was unimaginable to me 13 years ago. I don't share this to brag. I don't think I'm special. I share this to show what's possible if you focus on what matters. Your skills are investments that can also compound. So how is this relevant to a market crash? It's because focusing on the latest news and speculation of the market crash doesn't really matter. What matters is building valuable skills that are in demand. When or if the market crashes is completely outside your control. How you invest your time and energy is in your control. You are far more likely to succeed in doubling your income than trying to time the market. Every time you double your income, you can double the amount of money you're investing. Your odds of building wealth this way are significantly better than trying to time the market. I think this is one of the best things you can do. And I made a video with 6 tips to double your income, which I'll link up here and below. This is why I mostly ignore the latest market news like how the Fed is about to taper. Don't get me wrong, it's good to understand how the Fed works, but it's probably not going to improve your investment returns. I believe this type of news leads many people to having false confidence that they know more than they actually do. The data show it's better to focus on time in the market, not timing the market. To focus on your investment horizon. To focus on creating an investment plan that meets your goals. To focus on sticking to that investment plan. And finally, to focus on smashing the like button to support financial education. Increasing your value so you can invest more. Thanks for watching, everyone. Later.